I'd first like to welcome our viewers this evening. My name is Alan MacDonald, and I'm pleased to have with me Nikki Jafari of TD Canada Trust. Nikki is a mortgage specialist, and she's going to speak with us this evening about the various different aspects of mortgage financing and what's involved with qualifying for a mortgage, for example. And initially, Nikki's going to talk about the bank in terms of how they're willing to see people, regardless of where you think you might be in terms of potentially qualifying for a mortgage. They want you to know that their door is open and that she's more than happy to see you and to talk about what your needs are in the present tense or in the future tense. So with that, Nikki, I'll let you take it from there, and welcome.
Thank you, Alan. Thank you. Hello, everyone. My name is Nikki Jafari. I'm a mortgage specialist with TD Canada Trust, as Alan mentioned. And today we're going to talk about mortgage financing and mortgage pre-approvals. It's very, very important that from the very beginning you sit down and you talk to a mortgage specialist or your financial advisor. And when you're starting your home journey process, you need to start with the first block, and that's making sure that you have the right plan to get to where you want to go. So whether you've had some credit issues in the past, whether you are not sure about your job stability, you're not sure if you qualify, or you might be at a place where you know everything's good to go and you want to put an offer on a house tomorrow. When you sit down with a specialist, it gives you an actual snapshot, an overlook of where you are and where you want to go. And sometimes it could be that we work with you for a year or 2 years or 3 years to make sure that you have all your building blocks in a row, or it might be that you're in a place where you just start right off with a pre-approval and get you go, hook you up with Alan and get you going home shopping. So it really depends where you are in life, but sitting down with a professional will help you gauge where that is.
All right, so the message, I guess, initially is that we don't want people to assume that just because they may feel they don't qualify in the here and now, that that's a reason not to contact a mortgage specialist like Nikki. It's always best to contact her and have a discussion and just see exactly where you stand in that regard.
And a lot of times people feel bad. They feel like, oh, I don't want to waste someone's time, or they might feel like if I call someone now, I'm obligated that I have to go put an offer on a house tomorrow. And sometimes it's just a consultation. It's just to sit down, have a friendly conversation, get some brainstorming going on, and figure out where you are. And a lot of times people end up waiting years before they're actually ready to put an offer, and sometimes it could just be that they're ready and they go right off the bat, right off and put an offer. But you just need to start somewhere, and a lot of times that somewhere is just having a conversation with someone who knows how to get how to get you there. Yeah.
So I guess as part of that is basically what we're talking about is that you don't want people's perhaps or misconceptions to keep them from contacting you. It's best that they contact you and have that discussion and just find it exactly.
And a lot of people think it's worse than it actually is. I've had many clients where they feel like, oh my God, I would never qualify for a mortgage. And we sit down and we're like, no, you're actually okay. Or maybe if we made a little slight adjustment in your budget, or we made a little slight adjustment in your savings, or we maybe put you on a little plan for 6 months or a year's time. But there's always a way, and if we sit down with someone, they'll help you actualize that plan.
All right. So in short, you have to start somewhere.
Yeah.
So, and that will, a phone call is a good place to start.
Absolutely, and I'll be waiting.
All right, and this is a good place for us to start with the first segment of our presentation this evening.
Absolutely. Today we're going to talk about the different segments that when you sit down with someone and talk with them about a pre-approval, the different topics of conversation that will come up. So the first topic of conversation that's coming up will be down payment.
I think so. All right, Nikki, so now we're going to talk about down payment as it relates to this overall topic of mortgage financing. So
when you're looking to purchase a home, your down payment could come from various sources. So the approved sources for your down payment could be your accrued savings. So like money you put away through time, or maybe you sold a property, or just money that you have from your own savings and assets.
Okay, equity.
Equity. Another source of your down payment that's an acceptable source of down payment is the home buyer's plan, which is your RSP. So if you're contributing to an RSP plan, you can withdraw $25,000 per person and you have 15 years to pay it back. So that could be another source of your down payment. And for some people, it might be even to maybe take out an RSP loan to make their RSP contribution, and gradually then later on use that as their down payment, but there's some criteria that has to stay in the account for a certain period. So things like that we would talk to you about in the consultation session. But a home buyer's plan is another avenue. And the next thing is a gift. It could come from your immediate family member as long as there's a gift letter and an explanation where the money came from. Some banks require, even with the gift letter, that there be banking supporting where the gift is actually coming from, just to confirm it's not borrowed.
All right.
But those would be really, any of those three sources of money, down payment sources would be acceptable. Would be
acceptable to the bank. And for those who may have not caught the RSP reference, that's Registered Retirement Savings Plan.
Yes.
So it's a fairly
Thank God you're there to save me.
It's a fairly popular acronym, but perhaps not everyone is familiar with it. But it does in fact refer to the Registered Retirement Savings Plan program.
Yes.
All right, Nikki. So now we're going to talk about standard closing costs as it relates to mortgage financing and what's involved with those closing costs.
So a lot of times when we sit down and talk to people about that they have to have a certain down payment saved up, depending on which route or which program they're going with, we also budget for that, also closing costs. So your closing costs are things that are like, there are some closing costs that the bank will actually require you to show as part of your approval process. And there are some closing costs that you should keep in mind as a consumer to budget and plan for, because it's expenses you're going to be facing. So expenses like moving cost, home insurance, your maybe oil top-up, or property insurance, so your inspection, things like that are not bank-required expenses, but are things you should budget for. But bank-required closing costs that you have to show in your account are things like your legal costs, your deed-transfer tax, and you have to have property insurance in place. So those will be some of the closing costs that are a must, right, at approval process that you have to show that you have. Okay. And then there are costs that you just budget for before your closing date, so that you're not caught off guard.
All right, so it's important to make that distinction, so that some of those closing costs of the bank as part of your process needs to make sure that you've made provisions for those financially, and others they don't. However, as part of what I do, I have to explain all of those closing costs to a prospective buyer.
Yeah.
All right.
Okay. So we talked about closing costs that are considered that you must prove to the bank, and closing costs that you should budget for. There's also miscellaneous costs that you should budget for. So things like you might need appliances. You might need some minor or major renovations once you move into the house, or it might be an older home and you might start budgeting for the roof might be needed of repair in a very short distance after you move in, or things like that. Or you might need, for example, you might be moving from an apartment to a house and now you need to go buy a lawnmower or snow removal equipment. So those are additional cost factors that we will sit down with you in the pre-approval process, and we help you have a budget for everything. Not just the budget you need to approve for the deal, but the budget you need to comfortably live that dream.
All right, and I would add too that you're definitely going to need appliances unless you're going to eat out all the time.
Absolutely. Some homes, of course, come with appliances included, but some homes don't, and you might actually have to budget for that. And some of them might have older appliances that you move in, and then months later they're gone. I've had that happen. I've had clients close on a house, and shortly after they move in, and now it was an older appliance, and then now a stove went. So just little things like that. If you kind of always keep a budget as a homeowner for different unexpected surprises, then you'll never have that.
And for my part, I'll try to make sure that I sell them homes that when they do have appliances, the appliances are newer, and hopefully that they won't break down
That's a good
too
plan.
soon after they move in.
That's a great plan.
All right, so that's great, Nikki.
Thank you.
Thank you. So now we're going to talk about perhaps the more technical side of this process as it relates to how the bank qualifies someone in terms of looking at income, what the household income is against what it's actually going to cost to purchase a home, and so on. So perhaps you can speak to that.
Absolutely.
For us.
So when we're processing an application, a lot of it is determined by your household income or individual income, depending on how many applicants are going to be applying for the mortgage. So your total income that you show in an application has to service two things. One ratio we consider be called GDS, one ratio we call TDS. So GDS is the ratio of your income versus your household expenses. So your mortgage, your heat, your property taxes, anything that relates to your home purchase.
Okay.
Then when we consider TDS is your total debt. So your household purchase payments, in addition to your car payment, your visa payment, or any other debts that you may have. So based on the different programs out there and what down payment and what scenario we're going forward, those TDS and GDS scores might vary. Allowed GDS and TDS scores might vary, but your income will determine your purchasing price. So as long as we can keep those scores in line, we have to adjust the purchasing price according to that.
Or another way to put it would be your purchasing power, perhaps.
Absolutely.
That's another way to look at
So
it.
we budget backwards. So we kind of figure out how much income you have, what your TDS and GDS is, and based on that, we would say try to stay within this price range when you're making your purchase, so that you can have a comfortable purchasing experience, that you can carry the debt service ratios as well. It would increase your approval chances.
So in other words, if the household income, for sake of simplicity, was $100,000, the bank is going to take a percentage of that as it relates to gross debt service, and a higher percentage as it relates to that, as it relates to the total debt service ratio, if I can use that phrase. All right.
All right.
I think that's fairly clear. Thank you.
You're welcome.
All right. Now we're going to talk about rate holds, and that's perhaps one of the most, I think it's
most popular.
Well, it's popular. I think it's fairly important too in terms of that added security that people are going to feel as a result of obtaining a pre-approval.
When you're at a place where you've done your mortgage inquiries, you're all ready, and now you're ready to do your pre-approval. So what we do is we encourage you to lock in your rate. So you have, once you lock in a rate, you have 4 months to make your purchasing decision, and you have no obligations. There's no risk to you, but then you have that added protection. So if the rates go up, you're protected. If the rates go down, you can just rebook at a lower rate. So it's a great incentive that the banks offer, one that we definitely encourage you to use. Now, the one thing that I would strongly recommend is for your rate shop. So you definitely should know what's out in the market. You compare your rates, and then you always know that your mortgage broker is offering you the best rate. So I believe in my rates that much that I actually encourage people to rate shop. Then they have a better value, the added value for what they're getting.
They appreciate the value that you're going to give them.
Absolutely. But also what we always encourage when people are rate shopping is to make sure that they're comparing apples to apples. So a lot of times there might be rates out there that might seem like a great incentive, but when you look at the conditions and the fine prints, there might be a lot of catches in there. So there might be restrictions as far as prepayments or renewals or being able to transfer out your mortgage or pay out your mortgage or sell your home. There might be a lot of little conditions like that that you should really be reading the fine print and make sure that what you're comparing is actual, not apples to oranges, and is actual to identical products that you're comparing. And you should also look at privileges that each bank and the promotions that each bank are offering compared to the rates that they're offering. And the next thing that you really want to ensure is that you should shop around, but you should not do an application at every bank out there, because then it's hitting your credit bureau, and it's not beneficial, because every time you do an application, it gets packaged and sent to a certain way, and then you don't want. Is
it the beacon score?
Absolutely, it affects your beacon score, but also if, for example, I process an application for you with an inaccurate information, or maybe I don't update your information before I submit it, and then you go somewhere else and they submit it with a different information, and there's conflicting information. So it's always good that you sit down with a professional, that they know what they're doing, get one nice clean application in the first time, and then deal with that. Especially like sometimes we have applications that go through like an insurer like CMHC or Genworth, and perhaps one lender may have packaged a deal a certain way, then now another lender is trying to package it a certain way, so CMHC might get two conflicting information, and maybe an employment information or screen may have not been updated, or may have not been entered accurately, but with especially such a more strict lending guidelines out there these days, it's really crucial that the person really know what they're doing and how they're presenting that information.
So a discrepancy could be misconstrued or perhaps
Yes.
looked at in a way that it should have been. It could have been just an innocent mistake on the
It could have been an innocent mistake, and also it could just be that the person doesn't have sufficient experience in how to present the information.
Okay.
So because a person might fit under one program or might fit under another program, or it might be more suitable for one program rather than the other program. So there's so much finesse to mortgages these days. It's really important that you sit in front of a qualified person and make sure you get one clean application in the first time. Because the more questions are not addressed in advance, then there's more questions you have to answer once the application is submitted.
Sure.
So when we try to submit an application, we always look in from an underwriter's eyes and try to answer any questions that they might come up with before they even have the questions. That way it's a nice clean deal, they look at it, it's approved, it comes back, it's just smoother, as opposed to having a deal.
So you mean the mortgage underwriters themselves?
Absolutely.
Okay.
As opposed to having a mortgage that doesn't really, a file that doesn't really make sense, there's a lot of holes, it's not really presented well, or there's a lot of questions unanswered. Something as simple as a person may have had credit issues,
Sure.
but there might be a very justified answer for why that is. So if you can include that in your application process, it's actually an asset. Or they might have life insurance, there might be so many little things that could be added value to an application that the wrong person might not know to ask for it, to include it.
But I think perhaps the important message in that too is that there's no need to do more than one application, because if I understand you correctly, you should be able to get all the information that you need as you shop around for a mortgage rate and the conditions that are going to go with anything that another lender or any particular lender may be offering you. So at the time you make the application, you should be able to do it in an informed way.
Absolutely.
And with the lender that's offered you the most or the best, whatever suits that prospective individual.
Yes.
For the most part. So that's good to know. So, and the other point that you made as well, that perhaps I wouldn't think of all the time, but some folks might think that because they've actually made a full-blown application for a mortgage, that there's a legal obligation to actually take that mortgage at the end of the process. And
until your mortgage is funded, you can cancel at any time.
All right, yeah, and I think that's another important point that you made. Okay, that's great.
Thank you.
Thank you. All right, Nikki, now we're going to talk about another technical aspect of mortgage financing, I suppose, in terms of how it's packaged or how it's approached, the best way I can describe it. But we're going to talk about conventional mortgages versus high ratio mortgages and how that ties in with this whole discussion.
Perfect. So depending on how much down payment you're putting down is what's going to determine if it's going to be conventional or high ratio. So conventional means you're putting 20% or higher, assuming it's for your main residence. If it's a rental property, those would be different. But if it's for your main residence that you're purchasing, if you're putting 20% or higher down payment, then you don't have to get insurance. But if you are going to put 5% or higher, between 5 to 20%, whether it's through one of the insurers, CMHC or Genworth, or there's now a third insurer. If you go through any of those, you have to pay premiums. And the premiums protect the bank, so that if by any chance you don't make your mortgage payments, then CMHC covers the bank, so it's less risk to the bank. So that premium is calculated on a percentage basis. So there's a formula for that. We would calculate, depending on your purchase price and your down payment, we would calculate, so much dollars is your CMHC premium.
So I believe it's like a sliding scale. So the larger your down payment, the lower the premium.
Absolutely. So that fee could be paid as one lump sum payment up front, or we could tuck it into your mortgage and include it in your mortgage payments. The only thing to keep in mind is, let's say your CMHC premiums is $3,000. It's only $3,000 if you paid up front and one lump sum payment. Once we tuck it into your mortgage and you keep it over the life of your mortgage, and now you're paying insurance and paying interest on it, that's no longer going to cost you $3,000. So as long as you keep that in mind, it could be either part of your closing costs, or it could be tucked into your mortgage.
All right, well, it's nice to have that flexibility, even though I understand that if it was added into the principal amount of the mortgage, then of course it's going to be amortized over the full life of the mortgage, like the balance of the principal or the bulk of the principal. So yeah, that's understandable.
But it does come with some features. For example, like if you end up paying off your mortgage earlier than your contract time, and then you end up buying another mortgage, you might be able to transfer part of your CMHC premiums and things like that.
Okay.
But it's definitely something that you have to consider. You know, do you want to pay it up front, or do you want to tuck it into your mortgage?
Okay, so it would be much like a closing cost, I suppose, and it would be one of those costs that the bank would look for you to have.
Well, if you're going to pay it into your mortgage, you're tucking it into your mortgage, then you do not have to have it as part of your closing costs. But if you indicate that yes, client will pay this as a lump sum payment, then yes, we have to show that they have the funds for it.
Okay, and would it matter where those funds come from then, or that it be part of that whole discussion about the equity money again? Would it fall into that category in terms of?
In general, like almost all banks, any part of your closing costs, they want to see coming from your own savings and your own equity. So your closing costs, your down payment should come from a savings.
Okay, I understand.
Now there are exceptions granted sometimes, but for the most part, those are the guidelines.
Okay, that's great. So I think we've pretty much covered everything then as it relates to high ratio versus conventional.
Yeah.
But you did mention during the course of that people can still qualify with as little as 5% down.
Yes.
As well.
There are still some institutions that do offer the zero down, but for the most part, when you're getting a zero down mortgage, you're then getting a loan for the down payment, which you're paying back, or in some cases it's a cash back. So they're giving you a cash back mortgage, and that cash back then is applied to the down payment. But in that case, you're paying a higher interest rate. So all again is when we would sit down with you in your approval process and see what is the best solution for you. For some people, that might be the best solution, but it's definitely not the fit for everyone.
I think from a realtor's perspective, which of course is my perspective, for the most part, it's always better for someone to get into the market sooner than later. I think historically that would be the case. So
I have no advice on that. That's something that's your department. But we always try to tell people, in my personal opinion, is everything's better to do it safe than sorry, right? So you plan for it, you budget for it, you prepare for it.
Yes,
you
absolutely.
go in, and then there's no surprises, and there's no regrets, and there's no remorse. You can enjoy the purchase price. You're comfortable with your purchase price, and you can live a happy life, and then hopefully grow that home and into your next dream project. Exactly. But everything should have a step-by-step process.
Okay. All right. That's great. Thank you.
Thank you.
All right, Nikki. Now we're going to talk about another technical side of mortgage financing in terms of maybe prepayment privileges. Part of the discussion, and how that ties in with the amortization that someone may want with their mortgage, or may be necessary as a result of their income and so on and so forth. So perhaps you could speak about that.
Absolutely. So the life of your mortgage is what we call an amortization. So that's from the time you take out the mortgage till the time your mortgage free. So that entire duration we call your amortization. Then in between that, you sign smaller contracts. So they're called your terms. So you can have a 6 months, a 1 year, a 5 year, a 10 year. So depending on what type of contract you sell, you'll have a different term. And your term could be open, it could be closed, your rate could be variable, it could be open. So there's lots of different features within that. So what's important is that for the most part, the most amortization that you could be approved for these days is 25 years, with some exceptions, sometimes it's 30 years. So, but even though you qualify to have a 25-year amortization, doesn't mean you should take advantage of and take it, over a 25 year. You can qualify for 25 years if it's going to qualify your ratios, but you could try to adjust your payments to a shorter amortization period to wear down your mortgage faster. And if at any time you run into difficulties, you've already been approved for a longer amortization anyway, so you can just reduce your payments back to a longer amortization. But at least it gives you the incentive to try to make that little extra payment to see if you can become mortgage free faster. Another way that you can try to become mortgage-free faster is that most banks offer you the option to make lump sum payments. So you can make between 10, 15, 20% of your mortgage in a lump sum payment every year, depending on your institution. That could be in one single payment. It could be over several payments, as long as the amount does not exceed the allowed lump sum amount. So a lot of people take advantage of that. So if you're in a commission job, or you might have a bonus, you might have a GST check come in, you might have your tax return come in. So any of those money that you were not predicting to have, and it's just unexpected money, it's a great way to throw it onto your mortgage and become mortgage-free faster, because that goes right onto your principal. Another way would be your payment frequency. So for example, based on your pays, you might get paid bi-weekly or semi-monthly or monthly. So we can adjust your payments according to your pay dates to give you that comfort. But if you go on an accelerated program, you get some extra payments onto your mortgage every year, which will help. For example, if you're making your mortgage payments are $1,000 a month and you decide to go bi-weekly, we will adjust that. It's not just 24 payments, there's 26 payments in the year. But if you don't adjust for that, and we take that $1,000 and make it into $500 payments, and you will not really feel that extra 2 payments a month from your lifestyle, but that extra 2 payments a year that goes directly onto your principal, you will feel it at the end of your term, and you'll feel it at the end of your amortization. So those are different. A lot of people, when they're looking to become homeowners and they shop around, they tend to shop around rates. But these are also really important things to consider. So what are my privileges, my prepayment privileges with my bank and with my rate? So when I said compare apples to apples earlier in one of our earlier clips, this is the things I'm referring to. So are the prepayment privileges there? Are you able to double up your payments? Are you able to make the lump sum payments? Do you have all of those privileges that's going to help you become debt-free faster?
Yeah, well, it gives you that flexibility, which is very important. So I can see as part of that, then it might be desirable to initially have the longer amortization, because when you factor in those prepayment privileges, it gives you a lot of flexibility. So at the end of the day, you can pretty much shorten that down to something that's quite favorable if in fact you can afford to do it.
Yeah, and a lot of banks now offer where you can skip a mortgage payment, or they'll give you a break in case you run into some difficulties or financial hard times. So, I know TD Care and Trust is great for that. They have so many programs like that and benefits like that. So if you run into difficulties, we'll work with you and your family to help you overcome them. So always.
That's good to know.
Yeah. So we always try to encourage you to qualify for the longer amortization, but always try to set your payments on a shorter time frame so that we can help you become mortgage-free faster.
Okay, and I think that early on in this particular discussion you mentioned open term. So perhaps you could explain what an open term is, so our viewers can understand that as it relates to, or as it would compare to a fixed term, for example.
So an open, so variable and fixed would go together. So a variable rate means your rate is going to go up and down and fluctuate with prime, and a fixed rate, you're just locked into whatever your rate you negotiate, and that will be your rate for the term that you select. Where we're talking about open and close, your open mortgage, you're not locked into a contract. You may have a contract, but you're not locked in. So if you have a 6-month open contract, you could cancel at any time without any consequences. But if you have a 1-year closed contract, and you pay it off before the 1 year is due, there'll be penalties involved. So that penalty could be something we refer to as IRD, or it could be 3 months of interest. So depending on where the rates are in the market as opposed to the rate that you had when you originally took out the mortgage, they will either charge you the interest rate difference between the rate you had and the rate that's now, or 3 months interest, whichever one's a greater value, that's what you will pay. Now, most banks though have great programs. I know TD Care and Trust, again, offers great programs like that. So if you are able to pay out a mortgage, but then maybe you're buying another mortgage within a certain time frame, we could apply some of that, if not all of that penalty, back to you towards your new purchase. So there's a lot of...
Are you talking about portability, perhaps?
Portability would be when you take your current mortgage as is, you take it on to your next purchase, and you can, and that's your porting your mortgage. We have something called, like for example, where you blend the rate. So you may have a certain amount at one rate, then you take you top it up to a certain more amount at a new rate, we blend the two together,
Right.
you now have another mortgage. The other thing is called the replacement mortgage. So we actually pay out one mortgage completely, and then you might, a certain time frame is like every bank is different, 30 days, 60 days, 90 days before you could purchase your next home. And then you pay the penalty, but then you get the penalty back if you do another mortgage with the same bank.
So you get it credited back.
You get it credit back.
So
And there's something also called like bridge financing.
Mhm.
So sometimes between the one home that you buy and the home that you're selling, there might be a gap in between. So where your down payment's coming from the purchase of your current home and you're not going to have, we might do something called a bridge financing in between.
yes.
So there's so many different things out there, so I don't want to kind of go off, start rambling on with different things and get it confusing, but I just want it to be out there that there's different programs, and whether what's right for you or not, it's going to be based on your current
Depending on your circumstances, but it certainly sounds like there's an awful lot of flexibility,
Yes.
potentially, in terms of what someone might at the end of the day have as it relates to that mortgage that they complete the full application on. Perhaps you could give an example of why someone might take a 6-month open mortgage.
Well, for example, your mortgage might be coming up for renewal,
Mhm.
but your house is on the market to sell. So you do not want to lock into a contract, because at any point you could be selling your house and you don't want to be locked into paying a penalty.
Sure.
Or you might be at a limbo. A lot of people might be looking to first what we call flipping homes. So you're going to buy a home, you're going to renovate it, fix it, and then put it back on the market to sell it.
Okay.
Well, you don't want to be locked into a heavy contract, because you want to have the flexibility to be able to close that mortgage at any time.
Sure.
So there could be so many different reasons.
All right. Yeah, I just wanted to ask because I think it helps folks to relate to those different mortgage products, that they can reference them to a certain circumstance or situation.
Yeah.
So, anyway, I think that's great. We've pretty much covered everything then, as it relates to terms and amortization. So,
Yeah.
all right.
Thank you.
Thank you. All right then, Nikki. I think we're getting close to the end of our program,
Yes.
and I hope
We saved the best for last.
we saved the best for last, and I hope we've managed to answer a few questions for the folks this evening.
And
So-
if there's any other questions, we have our numbers at the end of the clip anyway. They're more than welcome to call back. And then if we miss something, we'll talk about them one-on-one.
Absolutely. So now we're getting to the tail end of the process, and we're going to assume that that the prospective homeowner has secured that mortgage, the ideal mortgage for them, and all of the terms that are right for them. And to wrap the process up, there's some security, some additional security that is available potentially to these folks. So you're going to speak to them.
Actually, for a lot of people, they leave this to the very end, and it's the last step for them.
Mhm.
But for me, when I meet with my clients, this is probably one of the very first steps I cover with them.
Okay.
Because life insurance, for me, is the most crucial part of such an investment for many different reasons. For one reason is, what if we're using 2 income to qualify you for the deal, and God forbid something unexpected comes up? Then now you're going to have a hard time to renew that mortgage or do anything with it, because now you have 1 income to work with. So hopefully nothing will happen, and it's always going to be blissful and everything's going to be happy.
Sure.
But in life, you should always be prepared for the worst. So when you talk about critical illness, you talk about life insurance,
Mhm.
it's a huge purchase. It's something that you should be prepared for. In case 1%, 1 in a million, something does happen,
Sure.
you want to have a plan B. You want to have that security in place. You want to think about it right from the get-go of you're even thinking about this process.
Mhm.
And also, having life insurance for a lot of times is it's actually a strength on an application. So I always ask about it right in my application process. Do you have life insurance? Do you
Sure.
have critical illness? Because then that's an asset that I could include in my application and in my packaging process.
Okay.
As well, if they never thought about it or if they don't have it, you plant the seed that they start thinking about it. What
Mhm.
happens if I lose 1 income in this household?
Exactly.
Or what happens if I get a critical illness and I recover from it, but then I'm out of commission for that time period and I've already lost everything? You know, for a lot of people, most people live paycheck to paycheck, and having 1 income and the household gone for 5, 6, 7 months where all the bills are piling up could make a huge difference. So
It could be stressful.
it could be stressful. I mean, you're already going through the stress of worrying about a loved one, then just adds one more stress to everything else going around. So life insurance and critical illness is something that I can't stress enough. That it's a conversation that's awkward, but it needs to be had,
Sure.
and it needs to be planned for.
Okay, so I think it's sort of the final, the final element in the, in the whole discussion. So it's just the final, the final thought as it relates to the security of going forward with this major decision, and I think it makes it clear that there really isn't any reason for someone to not proceed with this sort of purchase. And
most banks now, even if it's a construction mortgage, they allow you to, from the day you sign your commitment letters, to actually sign your insurance documents, and you're covered without paying premiums.
Oh.
And then if you decide to cancel your, before your payments are your premiums are starting to come out.
Yes.
If you want to cancel, you can. So you're, it unfortunately, being that this is what we do for a living, we see a lot of things that we wish we never had to see. So there's a lot of times people leave your office and before things even take off, and something might happen, right? So when you have that coverage in place, while you're going to shop around, while you're going to do things, you have a peace of mind in place. And a lot of times people forget, people have all the best of intentions, and then they forget about it. This way, at least you have your coverage. And if you and then you come up with something else, and then you come up with something else. But at least you know that you have something in place, and something is there in case of an emergency. So there is for a lot of banks now, they do offer insurance coverages without any cost to the consumer before your mortgage even finances.
Oh wow, that's very interesting.
Yeah.
I think it seems just to summarize that basically there's certainly a lot of thought that has gone into this whole process from the lender's point of view, and I don't think there's too much that's overlooked, and there's a lot of practical things, but it certainly looks so that the consumer has, if they do in fact sign the right mortgage document, that they're going to have something that's very workable, that's going to do the best for them in terms of their financial objective around owning.
We're trying to keep this recording today very generic, and it's a little bit harder, but when we actually meet with somebody first, one-on-one, depending on their knowledge, depending on their experience, if they're a first-time buyer, if they're, a little bit more seasoned, we would actually, sometimes there's first-time home buyers that I may meet 3, 4, 5 times.
Sure.
To slowly, step by step, explaining things, and kind of, doing that. Not necessarily to say hold hands, but they need a little more guidance. And then there are some people that they just need to know where they need to sign, and that's all they need to know. So everyone's different, and there's really no one size fits all. With mortgage financing, just like a home buying process, some clients might see the first home, and that's what they want to put an offer on, and some might want to see 50 homes, and then it's a very unique process, and it's
Absolutely.
very individual. Everyone's going to have their own take on it, but what matters is if you're working with the right team, then they're going to be patient. They're going to work with you till you find what fits right for you.
Exactly.
And that's when you'll know you're working with the right team.
All right, and I think if someone calls you, they're going to be working with the right person.
Well,
if not the right team. And I think we should mention before we conclude too, that in addition to speaking English, perhaps you can service people in another language?
Well, I speak,
Excuse me.
okay? I speak fluent Persian and Turkish, as well as a little English. But, I do work a lot with new immigrants, even the ones that don't necessarily speak any of those 3 languages. But I find with new immigrants, it's almost like a first-time buyer plus almost, because now they're completely in a new country, and there is a new way of doing banking, a new system.
Sure.
Everything's foreign, and it takes even that much longer, and the training process is that much more intensive, and we really take it that much slower. So I work with a lot of investment buyers, or non-resident buyers, or new immigrant buyers. Sure. So I think for everything in life, as long as you have the time, you have the patience, and you kind of take things step by step, everything always works out. And
I think it's great that you can speak to people in those other languages, because obviously they're going to be certainly more comfortable with the process as a result of you being able to do that. So I think that's great. So anyway, Nikki, I'd like to thank you for coming in this evening and doing this.
Well, thank you for having me on the show.
Doing this with me. And I have a little gift for you before you depart. This is a ball cap, obviously, and it has my real estate brand on it, listing for you.
I'll wear it right now. How's that look?
It looks very, very nice.
Well, there you go.
Hopefully the bank will let you wear it inside the branch, and I'll be very happy if they do.
Well, thank you very much for my gift. I appreciate it.
All right. Thanks once again,
Thanks so
Nikki.
much.
Okay.
Have a lovely day.
All right, same to you. Bye now. And thank you, folks,
Thank you, everyone, for your
watching.
time.
And good night.
Good night.